Welcome to the slideshow on retirement income. You will see this income filing quite frequently in our area of Tuolumne and Amador County. Retirement income is reported on lines 4 and 5 of the 1040. The gross amount is shown on the left side, 4A and 5A. The taxable portion is shown on the right side, 4B and 5B. Let's take a look at retirement income up close. Today, we'll learn about the documents needed to report retirement income and distributions. Many times, there will be a portion of the income that is not taxable. We will show you how to enter the information reported. We will also discuss when and how to adjust withholding. Let's get into the taxable amount on IRAs, 401ks, 403bs, pensions, and other retirement plans. Uncle Sam will let you save the money and let it grow tax-free, but eventually the government wants the tax on those savings. One key thing to remember: if it wasn't taxed when contributed, it's going to be taxed when distributed. The government will either take tax money that goes into the account or the money when it leaves the account. If the taxpayer did not contribute to the retirement plan, all the distributions are fully taxable. If the taxpayer made all contributions to a plan before tax dollars, the entire distribution is fully taxable. If the taxpayer made all contributions to a plan with after-tax dollars, then the distributions will be partially taxable. So what does the term partially taxable mean? When you contribute to a pension with after-tax dollars, only a portion of the non-taxable amount is applied each year. So there will be a larger portion that is taxable. Everything new that you have gained and contributed to this year's retirement account is taxable, but they won't tax you on any previous amount contributed since it has already been taxed. That portion of the distribution will not be taxed again. So what kind of documents are needed when filing? You already learned that a 1099 is for self-employment income, but a 1099-R, R for retirement, is a document that reports retirement income. Clients will bring this in and it will have the amount received, taxable portion, and the taxpayer's investment in the retirement plan. The numbers will be there for you to enter into TaxSlayer for filing. See 4012 Income tab Form 1099-R for examples of the 1099-R and where to put the information. Include all information from the 1099-R form. Once you input the gross distributions in box 1, the taxable amount automatically fills in the same amount. If box 2B is checked taxable amount not determined and there is an amount in box 9B, then you will click on the box to calculate the simplified method. We will discuss this method later on in the lesson. Remember, if filing a joint return, make sure the document is selected for either taxpayer or spouse. So what is the difference between a Roth IRA and a traditional IRA? Roth IRAs are the popular IRAs because the distributions are tax-free. We go back to our IRA nursery rhyme. If it is not taxed when contributed, it will be taxed when distributed. Roth IRAs tax when contributed. Traditional contributions may be fully or partially taxable, and Roth IRAs are not subject to the required minimum distribution rules. Traditional IRA distributions may be fully or partially taxable because the contributions may have been deductible or non-deductible. We are not trained to do SEP simple IRAs, so those are out of scope. Reporting IRA distributions is reporting the income that retirees receive. The amount from the IRA is distributed to them, and a code will be in box 7 for you to enter into TaxSlayer. Distribution code 7 is a normal distribution. This is the most common code. Distribution Code 1 is for an early distribution. Unless there is an exception, a penalty will be assessed. TaxSlayer will automatically compute the penalty and complete the form. Distribution Code G is for an IRA rollover. Box 2A should be 0 or blank. If there is an amount in Box 2A, the rollover is partially taxable. You will get a TaxSlayer warning and may have to complete the rollover section at the bottom of the TaxSlayer page. The Distribution Code 6, Section 1035 exchange is now in scope. It is not reported on the tax return. Look any codes up that you are unfamiliar with. So how do we compute the taxable amounts of distributions and payments? There must be an amount in Box 9B, Total Employee Contributions. If there's no amount, then the entire amount is taxable. You will also need both taxpayer's age at retirement, not the age at the end of the year, and the date of retirement, starting date of annuity, to compute the taxable amount. The simplified method writes off the taxable amount over the expected lifetime of the recipients. There is a worksheet in 4012, page D46, on how to enter this into TaxSlayer. Just as an FYI, a retirement annuity is an insurance contract that provides a reliable stream of income during retirement. When we are calculating the annuity start date, we are calculating the start date of that contract. So what if the taxpayer doesn't remember the starting date of the annuity? Work with them to figure it out. When did you retire? Did you start drawing your pension right away? Perhaps there is a TaxSlayer note on last year's tax return that can help you figure out the annuity start date. The age at start date is simply the start date minus the taxpayer's birth date. For joint and survivor pensions or annuities, the ages of both beneficiaries are used to calculate the taxable portion. Take a look at 4012, Income tab, Form 1099-R, Rollovers and Disability under Minimum Retirement Age. If Box 7 is checked with Code 3, the box on the Rollover or Disability screen should be checked if the client is under the minimum retirement age. Disability income is treated differently depending on the taxpayer's age, either taxed as wages or pension. The minimum age is generally the age when you can first receive a pension or annuity if you aren't disabled. The minimum age varies between employers, so we ask the taxpayer to clarify this upon intake. Form 5329 is used to eliminate any penalty for early withdrawal. It is claimed in TaxSlayer under Other Taxes and Payments. See your handbook 4012, tab H, Other Taxes, Payments, and Refundable Credits for instructions on completing Form 5329 and the exception codes. TaxSlayer will display an alert if the taxpayer owes more than $1,000. Some retirees are able to adjust their withholding online. If not, they should complete Form W4P or W4V. These forms are not in TaxSlayer and will need to be printed and provided to the client. Congratulations! You have made it through all the income lessons for the VITA program. The lesson we just covered involved identifying, calculating, and reporting the taxable portion of retirement income, types of retirement income forms used to report, and when adjustments to withholding may be needed. You will get more practice with the retirement income in a special in-person lab we will be doing, so you will have the chance for further review. Get familiar with these 3 points and the basic terms, and the rest we will follow up with you on an in-person lab. Here is what is out of scope for this lesson. Remember that out of scope is best to refer to a professional tax preparer for all parties involved.